What's the effective rate in that scenario?
That one that I just showed is my example. The effective rate on that one was a 30-year fixed, not a temporary buy down, to 30-year fixed at 5.5%.
Hello and welcome to another Mortgage Minute. My name is Matt Thomas. I'm joined today by Brian Daywald. Brian, how you doing this morning?
I'm doing well. Good to see you.
Awesome. Yeah, good to see you. Hey, we've got some exciting things to go over. We will certainly touch on rates as we always do in our Mortgage Minutes. We'll talk about what's affecting rates, but really we want to focus on a couple of other things. We're going to refer to it as what's called a market maneuver, and we're going to show you how people are really taking advantage of opportunities in this market, which is sort of the name of the game with Mortgage Minute anyway. We want to really bring that to the forefront. Brian, let's first talk about rates and where they're at. They're roughly in the low sixes, is that right?
Yeah, low to mid, let's say.
So they've been flirting with, the 3-year lows of 6.13. They've climbed up to about 6.3 in recent days. When we look at things in comparison, if you look at just 2 years ago, this time in 2023, we were just coming down off of rates hitting 8%. So the fact that they're in the low 6% right now, I think is a really positive thing. And yet, that is not the full story, in my opinion. Right. We really want to focus today on talking about the difference between the headline rate versus the booked rate. That's sort of a new concept, at least in those terms. We've talked about this a lot of times, but we haven't really categorized or defined it that way. But Brian, tell us the difference between a headline rate and a booked rate.
Yeah, so a booked rate is going to be, we've talked a lot about concessions, right? And when we use these concessions to buy down at the seller's expense and to obtain a lower interest rate, predominantly fixed interest rates, what gets booked or locked and closed is substantially lower and better than the headline rates that we see, again, somewhere in that 6.3 range at the moment.
Right, exactly. So people are hearing 6.3 now. Those who are waiting for things to really get dramatically better, they're thinking, well, 6.3 is better than 8% 2 years ago, but they may be thinking, I'd really like to see that number in the fives. And yet the booked rate, it's very common for those who are closing with a different booked rate are closing in the fives. And there are people that are closing actually in the fours. Is that correct?
True story. Yeah, so it's an interesting kind of dilemma that we look at, especially when we look at there's some math that we have to go through to figure out kind of the sweet spot between lowering the sales price and using the same amounts to get concessions to get the rate down. And it's pretty astronomical. The value that we get is much higher using those funds to buy the rate down than it is just to lower the sales price.
What's being reported is that about half or just over half, maybe just under half, about half of the people who are closing on properties right now are using some type of a buy down and they're getting a rate reduction. You're saying that in your pipeline and the people that you work with, that number is actually even higher. Is that right?
I think it's substantially higher, right? When we look at these figures, by the way, the average is up about 5% from where it was last year. So we're seeing more and more of these concessions come through. But I'm just so passionate about showing folks the math and why it makes so much more sense that we strategically offer this way. And it's got to be 90% or more of my contracts right now have concessions.
And it's interesting. I was having a conversation, just a text conversation with another mortgage lender who actually said that he isn't promoting those, isn't talking about those. And I just thought, man, what an absolute miss. What an unfortunate miss for his clients. You're going to actually show us a real life scenario where you're doing this. And again, we've done this before, but we just want to show you the impact of the difference between when you ask for concessions rather than a price reduction. And I just learned that it's 58% now of listings are taking price reductions. So that's very common. However, if you were to take as a buyer, if you made an offer on a place, instead of asking them for an additional price reduction and instead took concessions for that same amount, the savings to you could be tremendous. And Brian, do you want to show us what that looks like in real life?
Yeah, so here are some folks that went under contract just this weekend. We had this discussion on Friday about these figures, right? So in every scenario is going to be a little different, right? Based on credit scores and down payment and loan type and et cetera. But nonetheless, all of the math works out to be advantageous in my strategy. So I'm going to show you real quick here. This is the out of the box, right? This is the asking price on the house. It was $800K. And they said, gosh, what does it look like if we get a deal on the house? So with 5% down, the maximum concession we can obtain is 3% on a conventional loan. So what I showed him here is, listen, if we get
So
the house
24,000, right?
24K, yep, exactly. If we get the house for 3% less or 24K, we're buying it for 776 instead of 800, right? Decent deal, right? Our payment goes down right here, $144 a month. But if we use the same thing from a dollar amount and use it for concessions, that's this middle column here. So we buy it for the same price, but look what happens to the interest rate. It goes down a whole 1%. And if we look at the payment difference, instead of $144 a month that we see in column 3 here, it's almost a $500 difference in payment. We go from roughly $6,000 a month to $5,500 a month. And that's, this specific scenario. And like I said, every one of them is different,
Right.
but
They're financing a tremendous amount of that. That's why that number is that big.
That's a big chunk. Yeah. Big loan amount, but nonetheless, it's whether it's 2% or 6% or whether it's $1 million or 500,000 or less, it all makes more sense to use those funds for concessions than it does to lower the sales price.
What's the effective rate in that scenario?
That one I just showed is an example. The effective rate on that one was a 30-year fixed, not a temporary buy down, to 30-year fixed at 5.5%.
5.5?
Yeah, dropped from 6.5 to 5.5 with an APR at 5.8. And all of those are, contributed by the seller to get the rate down that low. Doesn't change how much cash they need to buy the house. It's just all in payment. And the system allows me to kind of forecast and look at, some of the long-term impacts, which is really quite interesting. We didn't get into that, but, if we look at what a 5-year difference is, some people's response will be, well, gosh, I'm just paying more for the house. Nope, not if we look at the total amount of interest paid over the next 5 years, it's substantially lower. And by paying a lower interest rate, the principal reduces faster. So it's a really neat, we'd have to get deep into the woods and show you some different calculations there, but it's for sure the winning strategy to get into a house these days.
Well, it's a small sacrifice if you want to look at it in those terms. I mean, if you're paying $800 for it, but getting those amount of concessions back versus just taking the price reduction. Yeah, you're saying that by reducing by a full percentage, your rate by a full percentage over time, over 30 years, that's going to be a massive savings. Forget the fact that you're paying $24,000 extra.
Yeah, even less than 10 years, it makes a giant impact.
Yeah, that's huge. And the impact to the seller is none.
Same.
I mean, the only impact that I can even think of would be it does need to appraise for $800, but in this case, the seller walks away with the identical amount of money. So it's really of no consequence to them. They should be agreeable for it. And so make sure that your agent is asking for these concessions rather than that price reduction. Now, if you can get both, that's great. If that home was already overpriced by $25,000, ask them to reduce it to the right price, but then get that concession built in there. The point is those concessions, in other words, a seller paying for your rate buy down essentially helps you out over 30 years.
It helps you out in the first month by in that scenario lowering the payment by $500. Big difference.
Huge difference. So the difference was you said at 776 was 140ish a month.
144.
Difference?
Yep, versus the asking price.
So that saves
using the
concessions, some decent amount of money. Nothing wrong with that.
It helps. Yep.
But the concessions, if you take that and reduce your rate, the impact is close to $500. Is that right?
Correct. Yep.
Yeah, that's huge.
Yep.
That's huge. So that is really the point that we wanted to make, that effective rate. You'll hear us talking about that, I think, more and more. Anyone who's looking to finance in the near term, we're going to talk to you about the effective rate and see if we can find a better rate for you. We can't just get you in, you can't just get a better rate necessarily, but we buy it down. When it's bought down, then you can essentially it's being paid for, and in this case by the seller, and then you get to enjoy the spoils of that for 30 years,
right?
And immediately feel it immediately.
And again, I want to concentrate. This isn't a temporary rate buy down, right? This isn't a 2-1 buy down or a 3-2-1 or whatever these things are. A lot of the folks that did those in the last couple of years are might be kicking themselves a little bit because now they've already adjusted up 2%. Whereas if we booked this from the get go, it could have been advantageous to have a flat, 30 fixed.
And it's a very important distinction to make as well. So again, Don't think of this as a temporary rate buy down. This is not that. This is a permanent rate buy down.
Correct.
This doesn't expire in 2 years or 3 years. It doesn't adjust in any fashion. It's a fixed rate. And it's essentially, like I said, the seller is just agreeing to pay for it. They're taking what they're getting for the house, contributing to you to make up the difference in what your rate cost would be. This is really, really a win-win. Again, the seller is not impacted if he or she were to take a price reduction on the same order, the exact same amount as this concessions. Instead, the impact is exactly the same to them. But the impact to the buyer is actually tremendous. So these are, again, are real life scenarios. This just happened. You just spoke with somebody last week about this. And this is somebody that's going to be able to take advantage of this themselves. So we would like to invite you all to reach out to us, to talk to us about how we can strategize to do the same for you. It really does have huge impact, and it's something that you should be aware of when you're meeting with your agent. We hope that this helps. We hope that you're able to take advantage of this in the future. And if we can help you in any way, please reach out to myself or to Brian. Thanks for your time today, Brian.
Thanks, Matt. Good to see you as always.